Hello guys, and welcome back to another video on my Hargreaves Lansdown ISA series, where I basically take you through my Hargreaves Lansdown stocks and shares ISA. It's currently got 6 funds in. I'll walk you through how they've all performed, my thoughts on the market, and any contributions I've made. In this episode, we've got actually quite a lot to talk about. So firstly, I got paid last week, so I was able to contribute a decent chunk, which has seen the value increase significantly. And the second thing is markets have been on a pretty big tear recently. So anyone who's been invested in the S&P 500 or global trackers or whatever you guys invest in will have seen some pretty significant gains over the last couple of weeks. So I want to talk about that as well. But yeah, let's just dive straight in. Before we do that, just want to remind everyone that this video is not financial advice. This is for education and entertainment purposes only. So yes, with that covered off, we'll come onto the Excel dashboard and go from there. All right, so here we are on the Excel dashboard, starting at the bottom. You can see, as I say, I got paid last week and I was able to contribute because life is not getting in the way anymore. Another 1,100, which makes it £2,000 over the last 2 months, after two months of dry spells due to unexpected expenses and that sort of thing. But we are looking positive now and should be able to continue that momentum up through the rest of the year. So that's really positive, very happy about that. Let's scroll up to the top and quickly tell you about where I've put that money. So with markets being on such a tear, which we'll come on to a bit later, there's something in my brain that doesn't like buying things when they're going up. I know a lot of people are quite good at that, buying into momentum, taking advantage of rallies, that sort of stuff. I'm sort of the opposite. I can only really buy things when they're down. So that's the basis behind where I put this money now. We've got healthcare, which I've talked about in many of my other videos. It's been hit really hard over the last 3-4 months or so. Over the long term, it's got that long-term driver of aging population, quite an unhealthy population. That's not going anywhere in the West. So for me, that's almost a no-brainer. The big niggle there, and the reason why it's down so much, is because of Trump and RFK and the things they're saying and doing about pharma prices. If they are able to get that through the political system and get their sort of desired changes onto pharma companies, that will be very damning for the sector, and I'm sure there'd be a big sell-off. But with the way things are going, Trump is definitely losing power, not in the literal sense, but in terms of sentiment amongst his peers and the general public. I'm sure you'll have noticed what's going on at the moment. So yeah, that's that. Let's see what happens there, but I'm happy to buy that when it's down, and I think again those long-term drivers still exist. And then the other £700 has gone into Polar Capital Global Insurance, which I've banged on about in every video. I think it's the sector is almost perfectly positioned for the coming 3 to 5 years. And even if that wasn't the case, I'd really find it hard to buy into any of the other funds given where markets are and what they've been performing like over recent weeks. Small caps I'd be more open to because the valuations are still pretty decent and we should be getting rate cuts. Again, I know I mentioned Trump just now, but he's really keen to get a dovish central banker in, i.e. someone who wants to do a lot of rate cuts. And I think that's not unlikely. So if he can get that through, smaller companies should be a big beneficiary of that. And then you've got tech and BlackRock Global Equity Unconstrained, which has a lot of the similar drivers to the tech fund, and they've just been on an absolute tear. Mega caps have been smashing it. The S&P's at all-time highs. It's at like 6,200, which makes me a bit worried and a bit concerned. So putting my money into funds that should perform better on the downside if we get some is my play at the moment. So scrolling down, you can see what that contribution has done to the charts and to our little table here that feeds into the charts. So I don't really need to pay attention to that really. We're almost at a point where we're getting gains on the portfolio. I think through the end of the year, with how we're positioned and especially Polar Capital Global Insurance, the managers recently uploaded a note to their website, which you can only see if you're a financial advisor or something. So you guys won't be able to read it probably, but I was able to read it. And they're very positive on the sector. They have been for a while. The managers are buying into it themselves, the fund that is, and it just makes a whole lot of sense. So for me, through the end of the year, I'm hoping that this little dark blue gain bar can creep on top of the blue bar, and then we'll get that smooth line going forward. And then you can see my portfolio over time started at 10,000 in March, up to just under 13 now, and that chart is looking a lot nicer, which is good. So let's go on to TrustNet now and talk about the markets more broadly and do some charting over there. Right, so rather annoyingly, as you can see on screen, TrustNet is choosing not to play ball today. It's choosing not to work, but I want to get this video out and update you guys on the portfolio. So I'm just going to talk through what's happened in markets. I might be able to use my TradingView account to talk through some things. So let's start with the S&P 500. because that's always fun. I mean, that is crazy. That chart is absolutely crazy. So you can see the tariff discussions sort of happened here and really picked up and just completely collapsed the market. And since that point, the S&P 500, which is US large cap, dominated by mega cap names, so the Magnificent Seven, Microsoft, Nvidia, Tesla, Apple, Microsoft, I don't know if I said that already, but if I didn't, then Microsoft. And it's now up 30% since a low, which I think is absolutely insane. Given everything that's going on right now, tariffs still are there. The economy has been very resilient, to be fair, but I just think it's very hard to justify a 23 times, 22 times P multiple on the index, given everything that's going on. So yes, I'll underperform. My portfolio will continue to underperform this if it carries on, but I'm happy to look through that. Medium term, I'm fine. I always find benchmarking portfolios, especially as sort of a retail investor, quite peculiar. You know, if I was told, for example, the market was going to do 15% a year for the next 10 years, or it could do, I don't know, this is quite hard to explain, but the way I'm trying to word it is, if I was told I could have in my portfolio 9 or 10% a year for the next decade, and you have no idea what's going to happen in broader markets, you could get a decade like the last decade, where it was sort of 12, 13% a year, or you could get one that was like the 2000s where you're flat for the 10 years. I would take that 9 to 10% a year without a doubt. And if it got to the end of that term and the market's done 15%, but I've only done 10, I would not be unhappy with that whatsoever. You've just generated 10% a year for a decade. You've seen huge returns in your investment. What does it matter if the market's done 15%? So what if someone else has done better than you? You need to be internally happy. So that's my perspective on that. Bit of a side tangent, but I suppose it gives you an insight into my investment philosophy. Next thing is the pound that I wanted to talk about. So as someone in the UK investing in the US, you've been pretty smashed by the pound. Since the start of the year, to its peak was up 13%, which means anything you held in US dollar terms, i.e. the S&P 500, i.e. 70% of a global equity tracker, will have been hit by a 13% headwind. Recently, because of Rachel Reeves and the ever impressive Labour government's developments, the pound sold off, and that also coincides with the US dollar actually sort of finding a floor and picking up a little bit, which is nice for, again, the UK investor investing internationally. What I'm looking for really is a spike up, maybe 3, 4, 5% in the dollar, which means 3 to 4, 5% down in the UK currency, and then I'm going to hedge out of all dollar risk because I think over the medium term, it's not in a great spot. I think the marginal flow is going to go out from the US, but yeah, we'll see what goes on there. Bitcoin's an interesting one, and it ties in, if you've got the NASDAQ up, which is a more tech-focused index, it would tie into what's going on in markets at the moment. There are some severe animal spirits, like there's a lot of froth, in my opinion. The fact that crypto's popping, the fact that the NASDAQ's popping, the fact that S&P 500 is back at all-time highs. That's not to say it can't continue. You know, I'm not comparing this to the dot-com bubble, but these periods of market sort of fiasco, frothiness can go on longer than you might expect. There's actually a famous quote that says, the market can stay irrational longer than you can stay solvent. But I think although this coincides to a sign that, again, markets are not in fearful mode. You know, and when you want to be deploying capital is when they are in fearful mode. You don't want to be unloading all of your cash into a greedy market, into the most speculative and most volatile parts of it especially. So that's what justifies my investment into the more defensive areas in healthcare and insurance at the moment. Gold's had an incredible time, but it's pretty much done nothing for a couple of months. That looks like it's flagging for a next leg up, but we'll see what happens there. Then I suppose you could look at the VIX, which basically, if the VIX is high, then people are scared, and it's probably a good time to buy into the market. If the VIX is low, the opposite is true. And you can see it's not particularly high at the moment. It's actually, you know, market participants are very happy to take on risk, which makes me quite unhappy to take on risk. So yeah, that's that. Unfortunately, Chosnet, let's see if, yeah, it's not working. So that's the best I can do for the moment. If you guys have any questions, actually, before we end, let's just talk about the FTSE, because again, I've been well, for the last 2 years, especially at my office, banging on about the UK. I know people have been saying it for years, like years and years, but finally the UK market has sort of woken up. We're at 9,000, 7,500 for what felt like years and years. Well, it was years and years. But now we're finally starting to see a pickup in the FTSE. I think a lot of the re-rating, or the easy part of the re-rating, has obviously happened now. You know, that 7,500 to 9,000 move is what? 20%. You've had your easy 20%. That's not to say I don't think it can re-rate further. I think it definitely can, especially if we get that marginal flow out of the US and more into international markets. But yeah, just respect to the FTSE. 9,000 is a nice number to see. So yeah, that's my ramblings on the market. If you enjoyed this video, please leave a like and share it. And if you have any questions, let me know in the comments. And yeah, see you in the next one.